2008 was a tumultuous year for the economy. The housing market collapse created one financial crisis after another, and it often seemed as if the news could only get worse.
And ultimately, our country could experience a long and painful recession. Fellow citizens, we must not let this happen.
Now, in predicting when and how the collapse would occur, my focus was again on the actions of our government.
What I think people are most upset about is that nobody went to jail. You know, if people had gone to jail, they wouldn't be quite so upset about the financial crisis.
Another part of what drove this was belief that home prices would never go down.
The Big Short, with its all-star cast, recounts the events of three groups of traders that bet against the housing market in the years before the subprime mortgage crisis that would eventually result in the failure of key financial institutions.
People have sort of a cursory knowledge of what happened in 2008, but when you start peeling away the layers of the fraud, it's incredibly terrifying.
The Big Short is unique as a high-budget Hollywood production that actually takes the time to properly portray the way that finance really worked behind the scenes, and uses financial events to progress the plot rather than focusing on wild parties, sports cars, and sexy ladies like some other equally fantastic movies that took a very different approach to storytelling.
The real question is this: was all this legal? Absolutely not.
Similarly to The Wolf of Wall Street, The Big Short is a movie based off of a book. Only The Wolf of Wall Street was an autobiography written by Jordan Belfort himself, and The Big Short, Inside the Doomsday Machine, was a standard non-fiction title that described the role of several players in the creation of the credit default market betting against the American housing market.
A bunch of people who borrowed money to buy a house, and are they going to pay off their loans or are they not? And the vast majority of the financial system was betting yes, that they're basically going to repay their loans, and some people bet no.
The Big Short was written by Michael Lewis, a veteran financial journalist, and the book really does read like a 320-page financial article, in that it's very information-dense, but also very well researched and verified. For this video, we will only be looking at the players that are in the movie, but the book does go into detail on some people that were either entirely cut from the film or merged into other characters to make the movie entertaining to a broader audience. Unfortunately, in the process of making it as appealing as possible to cinema goers, the movie did cut out some very important details, and also just straight up got some things wrong.
The biggest disadvantage we had was about the financial instruments and how to explain them. That was really the problem I saw. I thought the characters were incredible.
So it's time to learn how money works to give you guys an investment banker's insight into what really happened in The Big Short. The Big Short told the story of three main partners who took a short position or bet against the American housing market and the financial system that had grown around it in the early 2000s. The first of the three was the now infamous Michael J. Burry, a physician who gave up being a medical doctor to start a hedge fund, Scion Capital, in 2000.
Dr. Mike Burry, yes he does.
Burry had a lot of success in the hedge fund by shorting overvalued tech stocks and returned an average of 25% to his investors over the first 4 years, which is incredible. By 2004, he was managing $600 million for investors, which meant with his returns, he was making about $30 million a year for himself from a traditional hedge fund fee structure of 2 and 20. This means that the hedge fund manager was making 2% of all assets under management no matter what. So 2% of $600 million is $12 million, and 20% of the returns generated over the market. 20% of the excess returns he was generating at this time would have conservatively made him $18 million. His fund was so successful that by 2004, he stopped accepting new investors because his strategies relied on being able to move in and out of markets without influencing the markets themselves with huge order values. The Burry depicted in the movie was a bit of an eclectic guy, but it probably didn't do a great job of showing that he was already extremely wealthy by this point. Steve Eisman, played by everybody's favorite regional manager Steve Carell, had also managed a hedge fund, Front Point Partners, but his name was changed in the movie to Mark Baum. Eisman and his team also worked with Greg Lippmann, a Deutsche Bank trader, who was also betting against the housing market and was portrayed in the film by Ryan Gosling, with his name changed to Jared Vanette. And last, there is Cornwall Capital, renamed to Brownfield Capital in the movie, which had a much smaller pool of capital at play, but ended up generating the highest returns because of a clever play that will make sense by the end of this video. Burry's Scion Capital, Baum's Front Point Partners, and Brownfield Capital all had a problem. They wanted to short the housing market, but that's not possible to do directly. A short position normally works by temporarily borrowing an asset and selling it immediately for the current market price with hope that it will be less in the future. If the price does fall, the short seller can buy back the asset, give it back to the person they borrowed it off of, and make a profit on the difference between the sale price and the purchase price. That's much harder to do with housing, because nobody is going to let you borrow their house to sell it. All of the parties therefore ended up using credit default swaps. Credit default swaps sound complicated, but they are nothing more than regular insurance contracts that you would have for your car or your house. Car insurance is a contract between an insurance company and a car owner that promises to pay out in the event that the insured car gets into an accident. A credit default swap is an insurance contract between an insurance company or an investment bank and the owners of an interest-bearing asset like bonds or mortgage-backed securities. Mortgage-backed securities are supposed to pay out a fixed rate of return to their holders, and if they don't, the insurance company will pay out to make sure they are covered. What Michael Burry was doing in the scene was basically taking out insurance on a car he didn't own. If that car crashed, he would be able to collect the payout even though he never owned the car in the first place. Now replace the car with mortgage-backed securities and you should understand how this scene plays out. The problem for Burry is that he took out a lot of credit default swaps, and just like getting a lot of car insurance, he had to pay out the quarterly premiums on these policies to keep the coverage up. If the mortgage-backed securities never crashed, he would never get a payout, and he would have spent all of his investors' money on the Wall Street equivalent of Geico premiums. One thing that the movie doesn't quite get right is that Burry later tells his investors that he had a number of Wall Street banks create these credit default swaps, insinuating that taking out insurance on mortgage-backed securities was a totally new thing that Burry came up with. Credit default swaps, the insurance contracts, had actually been used since the 1990s, and they were used for a really interesting reason. Mortgage-backed securities were a collection of thousands of mortgages all put into a single pool to be sold off as a low-risk investment to other institutions. Selling these mortgages onto other investors gave the banks making these loans more cash so they could give out more mortgages, which Washington really loved, because it gave more people the opportunity to be homeowners. Making mortgage-backed securities and then selling them on the market is, however, a slow and complicated process done by lawyers and bankers who need to make sure thousands of mortgage contracts are properly accounted for in every single new mortgage-backed security they made. Most lenders outsourced this tedious process to bigger investment banks. This meant that the investment banks had to buy mortgages from the small banks and then keep those mortgages on their books for the 2 or 3 months it would take to properly package them as a new financial product. During that time, the bank ran the risk of those mortgages defaulting, which would cost them money. Normally this wouldn't be a huge deal, but the scale of mortgage-backed securities operations meant that some of these banks had trillions of dollars worth of mortgages on their books at any given time, which presented risk well above their tolerance. The investment banks didn't expect anything to go wrong, at least when they first started making mortgage-backed securities, but you also don't get car insurance expecting anything to go wrong. You get it because a car crash could cost you more than you could afford if you were unlucky enough to be involved in one. Credit default swaps let the investment banks keep trillions of dollars worth of assets on their books and collect their fee for making these products without the risk of anything going wrong. Unless, of course, a company like AIG, which was writing all of these insurance contracts, became insolvent. But that wasn't really seen as a possibility.
These private insurance contracts were called credit default swaps and would ultimately expose the giant conglomerate to $64 billion in potential subprime mortgage losses. And when the housing bubble burst, AIG didn't have enough money to meet its obligations.
Back to Michael Burry. He started taking on these insurance contracts in 2005, which was 3 years before he would eventually cash them out for a profit of over $800 million. He took insurance on some of the riskiest of mortgage-backed securities, which is the next mistake the movie made. It heavily implied that these financial products never went wrong prior to 2008, which they did, especially the riskier securities. This is why the insurance contracts existed in the first place.
In other words, we lose millions
until something that's never happened before happens?
That's correct.
Riskier assets would command higher premiums.
And the premiums?
Well, we pay roughly 80 to 90 million each year, which is high, but I was the first to do this trade. Watch, it will pay. I may have been early, but I'm not wrong.
A 22-year-old with a DUI will pay a higher premium to insure their 2004 Subaru WRX than a 45-year-old with a perfect driving record will on their 2022 Civic. It all comes down to the chance that the insurance provider will need to pay out. In a later scene, we see Mark Baum's hedge fund Front Point buy credit default swaps on BBB-rated mortgage-backed securities. A BBB rating means that these assets are risky and have approximately a 1% chance of failure in a given year according to rating agencies. Mortgage-backed securities could become safer or riskier in 2 ways. The first way is if they were just full of really safe mortgages of people with high incomes, good credit scores, and low loan sizes relative to the value of the homes. By the early 2000s, these didn't really exist, and good borrowers were mixed together with bad borrowers altogether.
I think it was, in fact, in retrospect,
a great big national, and not just national, global Ponzi scheme.
Banks instead made their product safer or riskier by layering them into tranches. Imagine 3 buckets that could be filled up with cash. The cash would come from the payments that people would make on their homes. All of this cash would go into the top bucket first, and then would overflow into the second bucket, and then to the third, and so on. The final bucket is the last to get paid, so it's the cheapest to buy, which means buying this bucket could generate a really good return on investment. If everybody is paying their mortgages, all of the buckets get filled up, and all of the investors get paid their money. If some people don't pay their mortgages, the last bucket in line might make nothing. But that's the risk that investors seeking higher returns would take. Structuring the mortgage bonds and cascading buckets for money created some desirable properties for investors. The first bucket would be much safer than any generic mortgage ever would be by itself, and the last bucket would offer higher returns than the interest rates on the loans. This created a market for risk-seeking investors and conservative investors, all with one asset class. The diversification that came with blending thousands of mortgages together into a single flow of money meant that returns were much more predictable, which gave a few Wall Street guys an idea. If you could mix together lots of mortgages, maybe you could do the same thing with lots of mortgage-backed securities, which themselves were a mix of a lot of mortgages. This was a collateralized debt obligation, or CDO. The thesis for these financial products was that they offered safety through diversification by getting returns from lots of risky mortgage buckets. They expected 1 or 2 of these buckets to fail, but those losses would be made up for by the high returns generated by the thousands of other buckets that they put into the product. A lot of these CDOs were also layered with their own buckets, and you might be able to see where this is going. Some firms took the lowest buckets from these CDOs and mixed them together to make new CDOs, which became known as CDOs squared. The diversification that came from mortgage-backed securities did protect investors from the risk that a single mortgage would default, or that even an entire region would default, but no amount of diversification could protect the system from the hose of cash feeding the entire system being shut off like it was in 2008. Fortunately, it was possible to take out insurance on any of these buckets that investors wanted by using credit default swaps. Now that you know the difference between mortgage-backed securities and collateralized debt obligations and how these products work, I can also point out one other little mistake that the movie made. In the sequence where Michael Burry goes between the investment banks trying to get them to write insurance contracts on mortgage-backed securities, he hands his counterparties a prospectus on the mortgage bonds that he would like to short.
I have prospectuses on 6 mortgage-backed securities I want to short.
Dr. Berry, these should be fine.
Yeah, we're prepared to sell you $5 million in credit default swaps on these mortgage bonds.
Can we make it $100 million?
Absolutely, we can make it $100 million.
The real Michael Burry actually took out swaps on collateralized debt obligations, which were the buckets made from the lots of other buckets.
Right, we bought basically short $8.4 billion of credit default swaps related to mortgages or financial companies.
You must have been pretty confident that this thing was going to blow
up. Well, we
up.
had a giant bet for us, and I was extremely confident in the outcome.
Were your investors as confident?
It's not a big mistake at all, but it's something you can annoyingly point out to your friends next time you decide to watch this movie. The finale of The Big Short plays out as the now infamous events of 2008 start occurring, and the incredibly complex financial products that these 3 parties have been betting against start falling in price. At this point, Brownfield, Scion, and Front Point had 2 ways to turn their short positions into cash. They could wait for the assets that they bet against to collapse and collect their insurance payout, or they could sell those insurance contracts back to the banks that were now desperate to get back that security.
It's Dr. Burry. Looks like the collapse of the financial sector is imminent. Let's start to sell my position. It's $1.3 billion.
They all opted for option 2, because as Michael Burry alluded to in an earlier scene, there was a possibility that these institutions would collapse, and they would never be able to collect on the payouts that were owed to them.
You want to bet against the housing market, and you're worried we won't pay you.
Yes, that's right.
This would be like if you crashed your car, only to find out that Geico had gone out of business before you could claim your insurance money. The reason that Brownfield was able to make much higher returns than Burry and Baum was because they bought insurance contracts on the assets that were much safer, the A and AA buckets instead of the BBB buckets that the larger hedge funds were buying. Because these assets were safer, the premiums on insurance contracts were lower, which meant that the pair could buy more with them with the limited pool of investor money they had.
This is what we did that no one else thought of. Not even Baum or Berry thought to short the AAs. But we did.
The final mistake I think the movie made was that they didn't do a great job of saying that almost all AAA mortgage-backed securities and more than 90% of A and AA securities did not fail, which meant that Brownfield wouldn't be able to collect on their premiums. But because the banks were so desperate to get their hands on insurance, as the financial system was unfolding, they were able to sell the contracts that they paid very little money for back to the banks at a huge premium. In the aftermath of The Big Short, all of the parties were left with a lot of money. Scion Capital was shut down immediately after because Michael Burry made so much money that he could support himself by just managing his own capital rather than dealing with the stress of outside investors, which was portrayed very well in this movie. This is called a family office, and the movie said that he only invests in water, which isn't true. And he has famously traded some well-publicized short positions in Tesla, as well as Cathie Wood's ARK Innovation ETF. None of his trades to date have been as successful as his one in The Big Short. Brownfield, which is really Cornwall Capital, still operates to this day, and has $262 million in assets under management according to their most recent Form 13F, down from their all-time high of $1.4 billion. But it's possible that this drop is due to investor withdrawals, not investment losses. America's angriest hedge fund, Front Point Partners, was shut down in 2011 after one of its senior managing partners, Chip Skowron, played loosely by Jeremy Strong in the film, pled guilty to insider trading, and was sentenced to 5 years in prison. These hedge funds made billions of dollars by executing The Big Short, but to some companies, that's less than they make or lose every single day.
Play it smart today, you won't look at tomorrow.
Tell Dad, meep. It's from Roadrunner.
Carrie, get Shiv a fucking medal.
Succession is an HBO TV series that focuses on the problematic family relationships of the Roy family patriarch Logan Roy and his 4 children, Kendall, Shiv, Roman, and Connor. The family is incredibly wealthy thanks to their company Waystar Royco, a conservative media conglomerate with operations in news, television, theme parks, and cruises. It's never overtly mentioned by the showrunners, but this is very similar to the real-life Murdoch family, who also own a media empire and have their fair share of family drama. At the very least, the show took a dash of inspiration from these controversial public figures.
Do you like the feeling of power you have as a newspaper proprietor, of being able to sort of formulate policies for a large number of newspapers in every state of Australia?
Well, there's only one honest answer to that, of course, and that's yes.
The driving force of family tension in the show is a series of big corporate events around the ownership of the company, with the children vying for control over the business when their elderly father, a man with declining health, passes on. You don't need to understand the details of the business deals to enjoy the show, but it would definitely help, and the producer style of show doesn't leave much room for explanation. So without an MBA or a background in corporate law, it is easy to get a little bit lost. There are 4 big business deals and ideas that you need to understand to fully grasp the complex Machiavellian backstabbing and family intrigue that takes place. I will also do my best to avoid any big spoilers pertaining to the plot and try to focus as much as possible on just the business side of things. The first thing to understand is why the Roy children are so desperate to take over the business in the first place and how that would actually work. It's quickly established that the family owns their share of Waystar Royco through a family holding company, which is in turn owned by a family trust, a very popular asset management structure for wealthy, high-profile business people. We see real-life examples of this exact holding structure all the time, because it protects the family's assets in the event that either Waystar gets sued or they themselves personally get sued, something that is highly likely given how the family members conduct themselves in the show. If you have watched my videos for a long time, you might remember me talking about the holding companies and trusts that were uncovered in the Panama Papers. The showrunners did the exact same thing here, so they obviously cared a lot about accuracy. There are 2 parties that you need to understand when talking about trusts: the trustee and the beneficiary. The beneficiary or beneficiaries is the parties that benefit from the payments made by the trust. Trust fund babies are called that because they are the beneficiaries of family trusts. The other party to understand is the trustee. The trustee is the manager of the trust, and they get to make decisions on what the trust does. If a trust wants to buy or sell an asset, for example, that decision is made by the trustee, not the beneficiary. A trustee can also be a beneficiary, but that's not always the case. A trustee can also be a representative like a family lawyer, or it can be a separate company, known as a corporate trustee, as is the case with the Roy Family Trust. The Roy Family Trust, which owns the Roy Family Holding Company, which in turn owns a majority stake in Waystar Royco, is managed by a corporate trustee that the family members all have voting shares in. The known members of the trustee company are Logan's ex-wife Caroline Collingwood, who also gave voting power to her 3 children, Shiv, Kendall, and Roman, as part of her divorce settlement that took place before the show started. The final 2 people with voting power are Connor Roy, the eldest son born to a mother who is never mentioned in the show, and Logan Roy himself. Logan has double voting power in the family holding company, presumably because he is a control freak and he was responsible for building the company that made the trust worth anything in the first place. Everybody else has 1 vote. If the family wants to make any big changes, they they can all vote on it using this corporate structure. The family trust simply does what the corporate trustee tells it to do, and the corporate trustee is just a shell company owned by these family members who can tell the company what to do through a shareholder vote. Early in the show, a big plot point is that Logan Roy wants to add his new wife to the family trust as a beneficiary, and change his will to have Marcia inherit his double voting power in the trustee company upon his death.
Are we okay?
Yeah, it's just some paperwork.
What, ahead of the announcement?
Putting Marcia on the trust, it's bullshit. And I just felt like checking in.
Oh, yeah, fine.
This causes quite a stir amongst the children, who all want to protect their control in the family trust, because it gives them control over the holding company and Waystar Royco itself.
And my seat also to go to her on my death.
What? Wait, that gives her double voting weight?
The children will all be wealthy no matter what, because the trust defines a stake that they each own in the company, which is worth between $500 million and $2 billion depending on the company's valuation throughout the series. This does not include any other asset that the family holding company could own, or any assets that the family members have acquired individually. All of them have beautiful homes and passion assets, so the Roy children are rich and they don't need the company, but they all want it because it gives them a lot of power even though it really shouldn't.
So important that children are supported and encouraged. And everything I've done for my children.
In the very first episode of the show, Kendall Roy, played by Jeremy Strong, is working for the company on a deal to acquire a new tech-focused media company with a stronger focus on younger, more liberal audiences called Vulture. This is an obvious nod to James Murdoch owning a 10% stake in Vice Media, but it also introduces one of the most important business activities in the show, which are mergers and acquisitions, which is the second thing to understand about the business deals in succession. The Vulture deal was a simple acquisition. A bigger company buys a smaller company for cash or stock and then uses the new company that they own to make them more money. The previous investors in the company are all bought out, and they do not own any part of the business at all anymore, so they want to make sure that they get the best possible price. This is called an exit, because this is how founders along with early investors exit their companies and turn their hard work into cash. If you are following along, the corporate structure would now look like this. The other type of M&A deal is a merger. This happens when two similarly sized companies come together. There are a lot of reasons that businesses would do this, or horizontal mergers where a company merges with another company that is a supplier or customer to theirs. In 1996, Time Warner, a cable company, merged with Turner Corporation, a media producer. This is a vertical merger, because Time Warner was Turner's customer before they merged to become one corporation. Time Warner could then offer their customers their own programming to make them more revenue. A horizontal merger is when two companies that were once competitors merge together. A big plot point in Season 2 is a potential merger between Waystar Royco's biggest competitor in the media space. Horizontal mergers are more difficult for businesses this big, especially in highly sensitive industries like media, because the SEC and FTC will challenge the merger if it would give the new company a monopoly over an industry. If Waystar became the only company in America broadcasting TV news, it would give them an unconscionable amount of power over what stories got covered and what stories got buried. Mergers can be a tricky operation, especially for publicly listed companies, because it will involve delisting one of the companies and compensating the shareholders of the old company in some way. Normally, this will be done by giving them stock in the new company, but sometimes it can just be done by paying them in cash. Mergers also have other considerations, like who will manage the company, which CEO will be let go, who will be on the board of directors, and what will the merged company even be called. Companies that have had big mergers in the past are easy to spot, because they will have two individual company names merged together. Daimler Chrysler, ExxonMobil, and for the astute viewers, Waystar Royco. It's never mentioned explicitly in the show, but the name and logo make it clear that the company has had a large merger in the past. The third thing to understand about the show is how the family could lose the company. Waystar Royco is a publicly listed company with other shareholders outside of the characters in the TV show, presumably pension funds, investment firms, and regular people with a Robinhood account. The family holding company owns a majority stake in the company, which gives them a lot of power in shareholder votes. The family can vote through their trustee company. This won't appear on shareholder issues. Whatever way they vote, the trustee will tell the trust to tell the holding company to cast the vote one way or another, and since they own most of the shares, they will always win any vote. This is challenged a few times because the executives at the company, including the family members who totally got their jobs based on merit, still have a fiduciary duty to their shareholders, and they are legally required to act in their best interest. The family could also lose their shares. Without spoiling too much, one of the family members used the shares in the holding company as collateral to make some big purchases.
Well, the thing is, it's secured against Waystar stock.
And when the stock hits 130, they can pursue repayment in full.
The deal with the loan was that if the value of those shares fell below a certain value, they could be taken by the bank giving the loan and sold on the market to make sure that the bank gets repaid their money. This is a margin call, and if it was big enough, it could potentially reduce the family's ownership to where they no longer have a majority control. It would also crash the stock's price, so all of the other investors might be angry enough to vote out the aging CEO and all of his nepo babies that got given senior roles at daddy's company. The other way that the family could lose control of the company is by being bought out. There is always a bigger fish in businesses, and at the end of the season, a coalition of wealthy business rivals, private equity bros, and a family insider teamed up for a bear hug.
It's great value for shareholders. Yeah, there it is. I'm not gonna get into feelings.
Is this a fucking bear hug?
That's right.
A bear hug is when a group of investors try to buy an entire company by offering to buy investors' shares for a premium over what they are trading for. Elon Musk famously bought Twitter for $45.20 a share, which was a funny number because 420, but it was also a 40% premium over what the Twitter stock was trading for at the time of his Twitter announcement. Most investors trying to perform a bear hug don't announce their plans on Twitter. They do it by approaching the company's board of directors with their offer. The board can reject the offer, but if the deal is good enough, they have to follow through because they have the duty to their shareholders to at least put it to a vote. If a bear hug is successful, shareholders can be forced to trade their shares for the cash price offered. Most shareholders will be happy to make the easy gains and will just reinvest their money into other companies, but others might not want to sell their shares even at a premium over what they're worth, because they believe that they could be worth more in the future. The bear hug in succession is first offered when Waystar stock is trading at a significantly lower price from the beginning of the show. Some shareholders would have taken a loss if they had bought in towards the top, and even the premium offered by the bear huggers would not be enough to put them in the black, so they might vote no on a deal so they don't have to lock in a loss on a position that could turn around. In the case of the Roy family, they don't want to sell, because those shares let them control a very influential company, and they have enough money anyway, and since they own a lot of shares, their say is very important. The fourth thing you need to understand about the business deals of secession is how the company was eventually stolen away from under the children's noses, even with all the protections offered by their voting power in the family trust.
But I mean, you know, the long and the short of it is, I saw their plan, and my dad's plan was better.
Remember, all of the family members have voting shares in the company that controls the trust, that controls the holding company, that controls Waystar. Logan Roy eventually decides that he is getting old and he wants to sell the company to a fictional equivalent of Netflix for a massive amount of money. He would not be able to get his children on board because if that deal went through, they would lose their positions and just become rich nobodies.
End of the day, that's all I fucking got.
Well, you know that's bullshit.
Logan gets around this by making a deal with his ex-wife who gave their children their voting rights through their divorce settlement. Logan trades a multi-million-dollar townhouse in London for her voting shares. That meant that the only other shareholder in the trustee was Connor, but it didn't matter what he said because Logan now had 6 votes to his 1. That's a supermajority, which means whatever he decides is what will happen. And his ultimate decision was to sell the company to make a lot of money and spite his entitled children.
And what's more, I will win.
Secession is a great show that I definitely recommend, even though all of the characters are absolutely terrible people.
All right, fuck it. Keep driving. Just press at my place, yeah?
Yes. So where are we going?
This is crazy. This is like OJ. I mean, except if OJ never killed anyone.
Who said I never killed anyone?
Art imitates life, and a lot of the shady corporate structuring and family power at the expense of the shareholders is very similar to a real-life corporate fraud that is allegedly unfolding right now. If you are watching a YouTube channel dedicated to finance and business, I am almost 100% confident that you have watched The Wolf of Wall Street at least a dozen times. It's an amazing movie that's gone on to inspire a generation of douchey sales bros around the world. But there is one line that still makes me angry 7 years later.
An IPO is an initial public offering. It's the first time a stock is offered for sale to the general population. Now, as the firm taking the company public, we set the initial sales price, then sold those shares right back to our friends. Look, I know you're not following what I'm saying anyway, right? That's okay, that doesn't matter.
No, I was following. It does matter. I even had my notepad and pen out ready to take notes. Yeah, well, if you were anything like me, you might have been thinking the same thing. But that's fine. The real Jordan Belfort himself said that the movie was only loosely based off the book that he wrote, and the book was only loosely based off reality. There were a lot of things intentionally left out of the book because if they were left in, they could be considered proceeds of crime. Similarly, there were lots of things left out of the movie because Martin Scorsese specializes in chronicling the rise and fall of organized crime figures, not analyzing fraudulent stock market activity. Jordan Belfort's career really picked up when he was laid off of his job at L.F. Rothschild, a New York-based stock brokerage. Back before the 2000s, buying stocks was not as simple as going online and typing in a ticker symbol. People would actually call a real living person, a stockbroker, and give them instructions on what stocks to buy and what stocks to sell. More often than not, it would actually work the other way around. The stockbroker would call their client and tell them what stock to buy and sell. The same was true of getting information. Here in 2021, if you want to know what the price of GME is, all you need to do is plug it into Google and hey, there it is. Back in the 80s, you either needed to wait for tomorrow's newspaper or call your broker to see what the market was up to. Now, as Matthew McConaughey so insightfully points out, nobody, I don't care if you're Warren Buffett or Jimmy Buffett, nobody knows if a stock is going up, down, sideways, or in f***ing circles. Least of all, stockbrokers. So, why did they do this then?
You and me, the brokers, we're taking home cold hard cash via commission, motherfucker. Right.
Yeah, that's right. They earn significant commissions by processing these trades. These days, we are used to zero-commission brokers, but that hasn't always been the case. In the 90s, it wasn't unusual for trades to cost as much as 2% of the total value of the assets being traded. A stockbroker would normally get 1% of that, and the firm that the stockbroker worked for would get the other 1%. Jordan Belfort would later go on to work at Investor Center. In reality, Jordan actually worked for a series of companies like this, but what the movie portrays is pretty indicative of these types of operations. These are what is called over-the-counter brokerages, which are very different from the exchange brokerages like L.F. Rothschild. Exchange brokerages facilitate trades on public exchanges. They would have a team of actual people down on the floor of the New York Stock Exchange calling out trades on behalf of the stockbrokers in their office who would be relaying trades from their clients. As we have seen, this system was still susceptible to unscrupulous behavior, mainly in the form of stockbrokers driving their clients to make as many trades as possible to drive up their commissions. But the exchange had some level of control over all the players in this game to make sure things didn't get too out of hand. If the exchange decided that a particular stockbroker or a particular stockbrokering company was acting in a way that was detrimental to the exchange's reputation, they deserved the right to kick them off the trading floor. This would destroy stock brokerages because if they can't make trades, they don't have a business. Exchanges also heavily regulate what companies are allowed to be listed on their exchanges. They audit financial statements, conduct background checks on the management, and make sure that the company's CEO's mother doesn't pick up the phone when you call their head office. Over-the-counter firms are different. They do not utilize the services of an exchange, and because of this, they do away with a lot of the regulation and oversight that comes with them. Companies can approach these over-the-counter firms directly and say, hey, I need $1 million to conduct funding on R&D on a new piece of radar tech that has both military and civilian applications. The stock firm will say, sure, but we keep 50% of all the money we raise for you. At best, these companies are just desperate for funding to get the idea off the ground, and at worst, they are also looking to defraud investors using any money they raise. Another thing is that 50% number was just a bit of Hollywood magic. The OTC brokers were likely only making 10 to 20% on these trades. Either way, it should be clear to see that any company that needs to offer a 20% cut to a stockbroker just to raise money is probably not worth investing in. And that is why Jordan Belfort and his colleagues resorted to high-pressure sales tactics on unsophisticated investors. Jordan eventually founded Stratton Oakmont, a subsidiary of Stratton Securities, which was a small-time dealer that could trade both over-the-counter and exchange-listed companies. Belfort and his co-founders, Brian Blake and Danny Porish, portrayed as Donnie Ozoff in the 2013 film, later bought out the entire firm and started to change how things would be run. Belfort had been making good money by, as he put it,
selling garbage to garbage men and making cash hand over fist.
But he had grander ambitions. He went on to hire a team of stockbrokers who would all aggressively pitch whatever stock he told them to. Before giving this order, he would call up unaffiliated but trustworthy connections who would buy up a large amount of stock in a small value company, preferably one with less than a $100 million market cap. Once his connections, affectionately called rat holes, owned a big enough portion of the company, he would instruct all of the brokers on his sales floor to go out and sell the stock to whoever would buy it. The buying frenzy would drive up the price, which would have the convenient side effect of making it easier to sell to new investors. This stock has doubled in value this last week. Get in now or you're going to miss out. Once the price of the stock had reached a certain level, Jordan would instruct his rat holes to start selling. While this was happening, Jordan's company would make it incredibly difficult for their regular clients to sell off the stock. Brokers would be instructed to not answer phone calls from investors looking to sell, or just to intentionally lose trade orders. This gave rat holes time to exit their positions, and as soon as regular investors could start selling their own stock, the price would collapse. The rat holes would then give money they made to Belfort while keeping a small cut for themselves. This scheme was taken to new heights when Stratton Oakmont started taking companies public. An initial public offering is when a company is first listed on a public exchange. There are lots of rules and regulations involved in this process, but the advantage to the business at the end of the day is that it becomes much easier to raise capital from public markets. Businesses will hire an underwriting firm to guide them through the process and assume some sort of risk of the whole operation. The underwriting firm will then be responsible for making sure the IPO is successful. A successful IPO really just means that all of the shares that the company wants to sell get sold at or above the agreed upon price. Normally, companies will go to investment banks to do their underwriting, but in its prime, Stratton Oakmont managed to court a few companies to use their services instead. You might have thought that the reintroduction of public exchanges into the mix would have slowed down Belfort's scheming. There was a reason he traded over-the-counter stocks in the first place, and that was to avoid the regulation and scrutiny that comes with these public markets. But Jordan didn't let that stand in his way. In fact, he developed a system to get the best out of both of these systems. Jordan would instruct his rat holes to buy up stock in a company that he was about to take public. The company would then debut on the public market, and then he would instruct his army of brokers to sell the IPO to all of their contacts. This would drive up the price of the stock just like it did before. But this time, because it was listed on a public market, it would attract the attention of other investors who didn't even know who Stratton Oakmont was. People would just hear the news that some IPO was up 50% at open, and then they would want to get in on that action. The rat holes could then use this buying mania to silently sell their stocks, netting them a very healthy profit. Jordan effectively combined the unregulated environment of over-the-counter operations with the inherent trust investors had in publicly traded stocks to create the ultimate money-making scam. And that's how you make
$22 million in 3 hours!
For those of you who haven't connected the dots yet, this is what you call a pump and dump. And it was the mechanism by which Jordan Belfort made millions. For a while, it actually looked like these schemes were becoming a thing of the past. Online stock trading platforms and easy access to market information meant that investors were no longer exposed to brokers who would hype up some shitty small cap company. Unfortunately, the rise of loosely regulated crypto markets has meant that pump and dump schemes are back with a vengeance. The only difference is today, the coked up stockbrokers have been swapped out for Discord communities and gaming influencers, and penny stocks have been replaced with stupid f***ing meme coins. Another important part of the movie was how Jordan hid his money once he had made it. The Pandora Papers are the latest in a long line of papers that have supposedly unmasked the shady dealings of the global elite's worldwide network of money laundering, tax evasion, and corruption. You have no doubt seen the headlines, and if you are following the story closely, you are likely thinking that nothing will really come of this. It's been 5 years since the Panama Papers were released to the world, and since then, they have been followed by the Paradise Papers as well as a series of smaller leaks ultimately confirming what everybody suspected was going on anyway. Now, to an outside observer, it is easy to be a bit disheartened by all of this news and simply resign yourself to the fact that these schemes will just happen forever and nothing will really be done to punish the perpetrators. This narrative would certainly be supported by the outlets publishing these stories too, because to be honest, outrage sells. But it's not necessarily the case. And perhaps the best way to see this is to do what no stories on this issue have been willing to do, and that is to unpack how this creative international accounting actually functions. So, it's time to learn how money works, to unpack the systems the super rich use to move their money around. As always, I want to say a huge thank you to my channel members and patrons on Patreon. You guys make less advertiser-friendly topics like this possible. If you want early access to videos and a bunch of other cool perks, please consider supporting the channel on either of these platforms. Alright, so there are really two things that you need to know about these papers and what they keep on uncovering. The first is how is it that these structures actually work? And I think the best way to show you that is just to teach you how to set up an international business network yourself. The other thing that I think should be better explained is the question of whether or not this is actually legal. The headlines that have come out can't seem to decide if they have uncovered the greatest fraud of all time, or whether they are just angry that all of this is technically legal. So this whole thing is really just the result of basic corporate structuring taken to the extreme. Limited liability companies are legal entities which, as their name suggests, have limited liability. What this means is that if the company goes bankrupt, the people that have put money into the company cannot lose any more than the amount that they invested. This is very important for modern finance because it means that investors can comfortably put money towards risky projects without the fear of losing their life savings if the company itself goes under. You probably would never invest in a company like Tesla in its early days if you were liable to lose more money than you invested in such a risky proposal. Now, companies are owned by shareholders. These shareholders can take one of three forms. The first and most obvious is a human person, which accountants and lawyers will refer to as a natural person. So when you hear the phrase natural person, think of squishy meat sacks. A shareholder can also be another company. Think of something like Warren Buffett's Berkshire Hathaway, which owns hundreds of smaller companies underneath it. Finally, a trust can also be a shareholder. Now, trusts are similar to corporations in a lot of ways. They are both separate legal entities, they can both hold assets, and they both have limited liability. Now, unlike a corporation, a trust is much simpler in its operation. While a company can do anything from manufacturing phones to building the next generation of spacecraft, a trust is simply an entity that holds onto stuff for the benefit of a predetermined entity, the beneficiary, and it is controlled by another predetermined entity, the trustee. A simple example is that the beneficiary is some millionaire's son who receives money from his trust fund that daddy set up for him, and the trustee is the person that has to explain to the pampered 35-year-old man-child that he is not letting him withdraw $1 million from his trust fund to set up a jet ski jousting league. If all of this sounds confusing so far, don't worry about it, because the best way to understand it all is to actually think of all these different types of entities as building blocks that can be put on top of one another in almost any combination you can think of. With that in mind, I want to teach you about one of the most robust corporate structures out there. Let's say you are a very successful businessman, legitimate or otherwise. Let's not ask too many questions just yet. You will have your company here, making lots of profits and generally doing what most regular companies do by providing a marketable good or service. The most basic way for you to own this company is just to be the direct shareholder of the operation. But if the company is big enough, you really don't want to do that for two reasons. The first is that if the company gets sued or goes bankrupt, you lose everything. Yes, it's a separate legal entity, so you won't personally be liable for any of the company's debts, but you still lose your business and your income stream. Instead, what you do is this. Put your profitable company down here, and create a holding company to own all of these shares in that business. You can also put especially valuable business assets, like a warehouse or a storefront, in this holding company. Now, when your business pays a dividend, it does not go to you directly, it goes to this holding company. If the operation business back down here gets sued, it doesn't matter, because it doesn't own anything that valuable. It can just declare bankruptcy and a new business can be made under the holding company who owns the warehouse and everything else of value. Now, if you are asking what happens if the holding company gets sued, you are starting to think like a real businessman. The thing is, this holding company is far less likely to be sued than an actual operating business, because it basically doesn't do anything other than own things. It doesn't enter into contracts, it doesn't employ people, it doesn't create products, it doesn't take on debt, it basically doesn't do anything that could put it in a position where it could be sued. So this is great, but we are not done yet. You want this holding company to in turn be held by a trust. That means that when the holding company passes money up, it doesn't go directly to you. It goes to this trust, which will then in turn pass money on to you. Now, if you remember, the trust fund needs a trustee, as in the person that decides when and what the trust fund pays to you, the beneficiary. For this, you need to set up yet another company. This company will do nothing apart from decide when money is paid out of the trust fund. It doesn't even have the authority to decide who it pays out to, because that is all predetermined in the rules of the trust itself. Now, this is starting to look crazy, but what does all of this actually do? This makes you financially invincible. If your actual operating business gets sued and goes bankrupt, oh well, it owns nothing, so you can just start another one a week later. If you get sued and need to declare bankruptcy, that also doesn't really matter. Why? Well, because on paper, you don't own any assets of value. Sure, you keep getting money from the trust fund here, but you can't own a trust fund. It's just a pass-through entity. The only shares that you actually personally own are the ones in the trustee company, but they are worthless. All they do is determine when a trust disbursement is paid. And oh, by the way, even if those shares are taken off you, it doesn't matter anyway, because a trust is required by law to pay out any cash it has on hand at least once a financial year to stop a situation where a rogue trustee can hold a beneficiary's money hostage. All of the things of real value are held in this holding company here in the middle of this corporate structure, which means that these assets are protected from both sides by what effectively amounts to limited liability corporate meat shields. It doesn't matter if anything that has any chance of going bankrupt actually does, because the assets will be safe and sound here in the middle. Now, there is absolutely nothing wrong with this structure. Almost every wealthy person in the world will employ something similar, if not identical, to protect themselves financially because an unfortunate reality of getting wealthy is getting sued. But here is where things get really interesting. There is no need for all of these entities to be registered in the same country. An American business can be owned by a British holding company, which feeds money into a trust set up in Singapore, which eventually feeds money to a Russian citizen. Of course, that's just a random example, and what the Pandora Papers discovered was that wealthy people were picking and choosing the countries to set up these businesses in extremely carefully. It's a common joke amongst international accountants that setting up these structures is kind of like going shopping for everything that you want. A bit of banking privacy from Panama, low corporate taxes from Ireland, and currency stability from France. Just snake your corporate structure through all of these jurisdictions, and you will walk away with all of these benefits stacked up on top of each other. Now, here are where things start to get a bit gray. It is specifically illegal in most countries to set up structures like this with the sole intention of avoiding taxes. How a lot of international businesses get around this rule is by saying that there was some other legitimate reason that it needed to be set up in so many countries. These can include having multiple offices around the world for business functions, owning multiple properties in different countries, or even wanting to move money from a country of operation to a country of residence. If an American investor owned a coal mine in Brazil, there is no problem with them having a Brazilian company owned by an American holding company. Deciding what international corporate structures are built for legitimate purposes and what structures are built for illegitimate purposes is where this gets difficult. Some jurisdictions have more registered corporations than citizens, so auditing every single last one of them is just not feasible. Even if it was, the guilty parties could very easily get around this issue by having a string of multiple holding companies which are each in a country with strong corporate privacy laws. If the Singaporean authorities get suspicious about a domestic holding company, which is in turn held by another foreign holding company, they would need to ring up the business regulator from the country where the other holding company was domiciled and ask them for details on the company's ownership structure. If that company is set up in a place like Montenegro, then the Singaporean financial authorities are likely to just get told to f themselves because local laws mean that this kind of information is kept secret. You can start to see the problem here, and you can start to see why these data leaks were such a big deal. For the first time, financial authorities and regular citizens alike had complete transparency of the structures that had been set up by some of the wealthiest people in the world. Again, while none of this was illegal by itself, it's pretty clear that someone putting this much time, effort, and money into making such a complex and opaque international business structure is not doing it just for asset protection or business operations. There is a common trend that was found amongst most of the more questionable leaked files. The operating businesses were usually based in countries with less than stellar records of corruption. The money from them would then be transferred to holding companies that operated in much more politically stable jurisdictions. London City, Singapore, and the Netherlands were all very popular choices. It's not worth going through all of this effort to hide and secure your assets if it's just going to get seized in some political revolution or economic meltdown. These holding companies in these stable countries would then be owned by a string of trusts and companies before ultimately being fed back to their owner in whatever country they lived in. So, has anything actually been done about this? Well, yes. A few big things, actually. It is easy to get disheartened about all of this rampant corruption and tax dodging going unpunished, but the information revealed in the Panama Papers and other subsequent leaks has led to the arrest of dozens of high-profile officials, the resignation of a prime minister, and the return of hundreds of billions of dollars to tax agencies all over the world. The second thing that it did was introduce widely recognized standards for registered companies to list beneficial owners. If you are trying to set up a new business today, in most countries around the world, a major question you will get asked is who are the beneficial owners? A beneficial owner is the natural person that receives the profits from the business at the end of everything. The need for it to be a natural person means that the endless cobweb of shell companies does nothing, because you still need to list an actual person at the end of it all. The third thing that it did was heighten the scrutiny placed on certain individuals known in the industry as PEPs, or politically exposed persons. If the beneficial owner of the company is someone who holds public office or a senior position in a large company, they are liable to be involved in corruption. It's because of this that new international banking laws require these individuals to declare themselves when doing so much as opening up a bank account. This means that countries know where to start when auditing new companies, minimizing the chances that these individuals can hide their ill-gotten gains. The final major thing is the push for a global minimum tax. As I was creating this video, Ireland, a famous destination for international corporate structures, agreed to implement a 15% corporate tax as a part of the global minimum tax rate proposal. This scheme would not likely have nearly the momentum it has today if it weren't for these leaks exposing how big this issue was. It's easy to get disheartened by people saying that nothing will ever come of this, but that apathy is exactly what these fraudulent operations want. If people think nothing will come of these reports, then people will stop caring about the reports. If people stop caring about the reports, then media outlets won't publish them. And if media outlets won't publish them, then they will never be investigated in the first place. Now, if you were thinking throughout this entire video, if you can't beat them, join them, I like your style. Go and watch my video on what to do if you get rich so that you too can be an internationally condemned businessman.